What is up, YouTube? Adam O'Dell, Chief Investment Strategist of moneymarkets.com. And I'm joined again this week by my research analyst, Matt Clark. And we're here for another episode of Ask Adam Anything. Please leave in the comments of YouTube here, or you can email us as well. We will leave the email down below. Any questions you have, stock specific, market in general, investing strategies in general, I'm happy to answer your questions from my point of view. So with that, Matt, I know there's some news on Google out, and we've been getting some questions from our own subscriber base as far as what's going on with Google. And so I'll let you kind of tee up the question in that regard.
For sure. And yeah, if you do have a question, the email address is feedback@moneymarkets.com. Again, we'll put that down below, feedback@moneymarkets.com. Also comment down below here on our YouTube channel. We read them all. We love to see them. Any question you have that's related to a particular stock or a sector or anything like that, then, they could be addressable to Adam, Charles, or myself. We'd love to get into that and answer that for you. But yes, in terms of big news and things like that. There's always big talk has been on inflation and how that's impacting stocks and whether that means a sector rotation, all that sort of stuff. What I want to focus on today is on one of the stocks, one of the companies that moves the market exponentially. There are 4 or 5, 6 companies that any big market move has can cause a huge shift in overall broader indices. And the one I want to talk about today is Google. And the question that we keep getting over and over again is that, they have planned a stock split. And so what I want to do, Adam, is I want to pick your brain. And first off, talk about briefly what is a stock split for those who may not know. And then let's dive deeper and see, what does a stock split mean for investors who either may be looking at Google as a potential investment or may already have Google in their portfolio?
Yeah, absolutely, Matt. So first of all, you hit on a good point that a lot of these big tech companies, large market cap companies, move the major stock indices more so than smaller companies. So like we're talking about the S&P 500 and the NASDAQ 100, these are market cap weighted indexes. So larger companies by market cap, not by their share price, but by market cap, they will have a larger allocation of that index. And so a 1% move in Google, which is a large market cap stock, a mega cap stock, is going to have more of an impact on the S&P 500 than a smaller company, half its size or a tenth of its size. So that's a good point to start off with. So Google shares, ticker symbol, the voting class shares, the shares where you get 1 vote per share, ticker symbol GOOGL. They're trading upwards of $3,000 per share recently. In fact, Google just released its latest quarterly earnings for the period ending December of last year. And they just came out with banger numbers. They were absolutely monster growth rates in the 30 to 40% range. Revenue, net income, the profit margin is growing. This is, just astonishing for a company so large that the growth rates are so fat. But basically on that news, the shares jumped 10% overnight. They opened up well over $3,000 per share for a new all-time high there. So basically at $3,000 a share, most brokerage firms offer fractional shares where you don't have to buy a full share of the stock for a high priced stock like Google. But nonetheless, before fractional shares were a thing, and even now with them being available, it basically kind of priced out some retail investors who have smaller accounts. Let's say you have a $10,000 account and you want to spread that across a number of stocks so you're diversified and you don't want to buy an index fund, but putting $3,000 into one share of Google might takes up 30% of that account at that number. So some smaller retail investors are somewhat dissuaded from buying stocks that have a high per share price. And that kind of keeps the pool of potential investors in that type of stock more limited than if the stock were priced at $100 a share. So stock splits are fairly common. They're less common now than they used to be, but they're fairly common, certainly for a stock that's priced over $1,000. So Google announced that they plan to do a 20-for-1 stock split. And basically what's going to happen is this doesn't happen until July. Okay, so the shareholders have to vote on this. It's very likely to go through, but this will happen on July 15th, assuming that it goes through, and any shareholder of record as of July 1st will be part of this conversion. Now, what the conversion means is that basically on that date, July 15th, the per share price of Google will be divided by 20. Okay, so it'll be 1/20th the price of what it was the day before. So just using round numbers, if shares of Google were trading at $3,000 a share on July 14th, they'll be trading at $150 a share on July 15th. That's 1/20th the price previously. Now, to make up for that, every shareholder is going to get 19 extra shares for every one share they own. So instead of owning one share of Google priced at $3,000, you will later own 20 shares of Google priced at $150. Now, if you do the math and if you realize those are perfectly offsetting adjustments, you're right. There's no change in the overall market cap of a stock when a stock split is done. Basically, it lowers the per share price and you get more shares outstanding and in your account. And it's basically a net wash on the market cap. So you don't need to worry about it changing the value of your position, in a negative way at all. But that's basically how stock splits work. And one of the reasons I mentioned is that it broadens the pool of potential investors. Another reason, there's speculation that this would pave the way for Google being added to another index, the Dow Jones Industrial Average, which is typically, it was a much smaller index. It's only 30 stocks right now. But that's actually a price weighted index. So they basically higher priced stocks on a per share basis have a higher weighting in the Dow Jones. So a stock like Google at $3,000 per share, it's not practical for it to be added to a price weighted index like the Dow, because a 1% move in Google would make the Dow move like, I don't know, 10 or 15%. It would have a huge unjustified outsized move in that. So proportionately, the Dow is looking for stocks that are more in the $100, $200 range. So basically, the 20-for-1 split puts Google most likely in the $100 and some dollar range, 150 as of right now, and that could pave the way for being added to that index. And that's good because passive flows drive a lot of performance in stocks. So you've got people that every single week or every other week, they're putting some allocation of their 401k into an index fund. And if that index fund happens to be the Dow Jones Industrial Average, then the manager of that ETF has to go out and buy shares of Google, and that creates demand for shares of Google. So all in all, as you know, Matt, we're a team here, myself, you, and Charles, and we think this is actually bullish for Google stock. And we're going to continue to update our subscribers, and maybe we'll do a follow-up video as we get closer to that stock split.
Yeah, so basically the bottom line here is that, number one, if you already own shares of Google, nothing is going to change, only the number of shares that you hold. The value of those shares, individually will change, but collectively will be the same. So based on whatever that is on July 14th, 15th, that's what you can expect. Now, for if you are on the fence and thinking about an investment into Google, what this does is it brings that price down. It doesn't really change the metrics in terms of valuation, but it does make it in terms of just raw cash into your portfolio. It does make it a little more attractive, as Adam said. You're not so heavily priced out of buying into something like Google. So, and again, the Dow Jones Industrial Average potential is big. And yes, we remain very bullish on Google, and I think it's going to be a subject we will talk about leading up to July and even after that. Now, something else to kind of consider here is that you mentioned this is not uncommon. We have seen companies do this more so 10, 20 years ago, even 5 years ago. Not as much of late, but it still does happen. Historically, what is the expectation, or what do the trends tell you in terms of what this will do for Google and its price potential after the split is complete?
Yeah, this is where it gets really interesting, because just the conversion of having 20 more shares and a 1/20th of the price, that is no net change, but it does signal something to the market about the company and that stock. And basically, Bank of America has done some research looking at all companies and the performance of their stock after they announced the split. Now, this isn't after the split actually happened, it's after they announced the split. So again, that's why it's signaling to the market. And what they found is over the following 3, 6, and 12 months following that split announcement, that stock generally, on average, outperforms the market by a fairly wide degree. We'll try to put up the chart, but over a 3-month period, the S&P 500 on average earns 2.1%. Stock split announced stocks earn 7.8% over 3 months. So it's nearly 4 times, 3.5 times the performance. Over a 6-month period, the S&P is up 4.4% on average, and stock split are up 13.9%. And then that momentum effect even lasts for 12 months. So the S&P over 12 months is up an average of 9.1%. And stock split stocks have an average gain of 25.4%. So some of that can be owed to just operational excellence. I mean, you think about it, it's difficult for a struggling company. I mean, like Peloton, right? It's difficult for a struggling company to climb to $1,000 and $2,000 and $3,000 a share. Usually they're going the opposite direction. And then the other factor that this can be owed to is just simply the momentum factor. We know that positive price momentum tends to last longer than people expect. So, again, a stock that's gone from 1,000, 2,000, 3,000 tends to continue going higher. So, but nonetheless, it definitely is in the numbers that you can get some outperformance from stocks that have announced splits. We were bullish on Google well before this split was announced and before this earnings release. But if nothing else, that gives us further confidence in the future of this position.
So again, bottom line here is that the trends would suggest that the news is good for Google in the future following the stock split. It's not an automatic. It's not, we're not suggesting that it's, this crystal ball that we have, which we don't, and nobody does actually, is going to produce this. But we are very strong in the conviction that Google is going to do very, very well in the next 12 to 24 months, even beyond that. So, I would encourage that if you are interested in learning more and getting access to more research, more data, more information, and more access with Charles, Adam, and myself, then subscribe to our Green Zone Fortunes subscription investment service. We'll put up a link up here where you can find out more information. Also, don't forget to check out moneyandmarkets.com. You can use our proprietary, I say our, but actually it is ours, but Adam developed it. He worked very hard, spent years of work, blood, sweat, and tears, I know, to develop it, but it is out. It ranks any number of up to 6,000-7,000 stocks that we rate on moneyandmarkets.com. You'll be able to see our metrics, how they're broken down, and get an overall score in addition to chart data, fundamental data, all sorts of great stuff. And anything that we've written about these particular companies, just put in a ticker in the top right corner of the search bar, and you'll be able to find it very, very easy. You can create a watch list at moneymarkets.com. So if maybe you have some stocks you're looking for, you want to kind of track their progress before you buy, or maybe you already have and you want to track them, you can do all that. And by the way, you can do all that for free. So check out moneymarkets.com. By the way, just before one thing I want to look up, in 2004, 6 years after Google was founded, the company had IPO'd, and its IPO price, $85 per share. And now it is upwards of $3,000. And so even if you factor in the stock split, and all those things would be adjusted based on the 20%, the 1 for 20 or the 20 for 1. That's a pretty impressive move in that kind of time for Google, and I think it's going to continue. So, Adam, appreciate the time. Really look forward to doing this each and every week. And until next time, he is Adam O'Dell. He is a chief investment strategist for Money and Markets, and he is the head of all things great when it comes to investing. I say that in not in jest, but in loving fashion only. And I am Matt Clark. I'm research analyst for Money and Markets. Until next time, everyone, safe trading.